So when people are talking about insurance companies becoming insolvent, I mean, it's a pretty simple formula, right? If you look at the liabilities of an insurance company and you look at their policyholder surpluses, if the liabilities exceed the policyholder surplus, then you're insolvent, right? If that happens, the Office of Insurance Regulation would basically put you in receivership at that point. And then they would go and start selling off your assets and start trying to wind down the business, and then go ahead and try to pay out the remaining claims and reimburse people for their unearned premiums. Now, we've had a number of these happen over the past 2 years. Just in this year, I think we've had 4 insolvencies just since January 1st of 2022. And there's some concern that potentially we could have some more insolvencies going into this reinsurance treaty cycle. So if you're a Florida domestic insurance company, usually your reinsurance treaties have to be completed, your entire program, by June 1st. Now, if you're having difficulty completing your reinsurance program, maybe for a number of reasons, maybe reinsurers view you as a credit risk. Maybe reinsurers are, pulling capacity out of the state. Maybe the price or terms that the reinsurers want to offer you is not economically feasible for you to move forward with your operations. So there's a number of things that are going on in that space that could potentially put an insurance company into, a posture where they're at risk for insolvency. So the impacts for consumers, if an insurance company becomes insolvent, is numerous, right? So if you're a policyholder of one of those insurance companies, it's very likely that you're going to get a cancellation notice, right? So you may only have 30 days to try to find another insurance company. In our current insurance market, there's not a lot of availability for new insurance. Now, there will be insurance companies that will look at a company that maybe went insolvent. They'll look at their book of business and they'll see if there's, some of those policies meet their underwriting criteria, from a price standpoint and a risk exposure standpoint, and they may make an offer to take some of that business. Depending upon, what those policies look like as far as the risk, the structures of the property, and what that insurance company was charging for that rate. If they were charging an actuarially indicated rate, there may be a greater probability that the private market may want to take some of those policies. But if not, then you need to start shopping, start looking for other insurance. And for some people, the only possibility may be going to the residual market mechanism, which is Citizens Property Insurance Corporation here in the state of Florida. So they are a quasi, government operation that provides primary insurance as a last resort for consumers. But even Citizens has its own underwriting guidelines. And it could be potentially if you've had a certain amount of claims within a certain number of years, or you don't have a certain amount of useful life left in your roof, you may not qualify for coverage even with Citizens. That can really put policyholders in a very difficult position because many of them, if they have a mortgage, are required to have coverage on these homes. So if your mortgage company gets a letter saying your policy is going to be canceled, you can't find a private market option, Citizens, you don't meet Citizens underwriting criteria, your mortgage company can force place an insurance policy to cover the balance of the mortgage. Usually those insurance policies that are force placed are usually double or triple the cost of what the private market price is. And usually the coverage is much less comprehensive of what you could find in the marketplace. And many times, even though you're paying the cost for that insurance policy through your mortgage, you're not the policyholder. They will list the bank as the actual insured. So if there's a claim, those monies and those funds go directly to the mortgage company to manage them. You really lose all control of the insurance proceeds as the homeowner. Everything is dictated by the mortgage company. So that's a difficult position. There's also financial impacts. If an insurance company becomes insolvent, they have to pay all the outstanding claims, right? They have to pay back all the unearned premium. Once they liquidate the insurance company, that may not be enough money to meet all these liabilities, which then FIGA would step in, which is a state institution here in Florida that helps process all these insolvent claims from these carriers. But if there's a liability that's not cured, I guess, from selling all the assets, what FIGA can do is they can go to the office and ask permission to assess policyholders all across the state. So then, even if you weren't a policyholder of that insurance company that went insolvent, you may get an assessment on your bill to pay the claims of all those outstanding claims or liabilities.